Hey, Grand Rapids, did you know home prices are up another 15.5% year over year? Well, they are. Welcome to the Grand Rapids, Michigan, Kent County residential real estate market update with data through April 2022. My name is Rodney Constable. I'm a realtor with 616 Realty in Grand Rapids, Michigan. Year over year, home prices are up 15.5% in the Grand Rapids area, with the average home now selling for $339,819. The average home 1 year ago was selling for $294,115. For years, I've heard people saying things like home prices can't continue to go up. Well, when I hear things like that, I think about the input costs to building a home. And some of the major input costs to building a home are land, labor, materials, and regulatory costs. So if somebody thinks that home prices cannot continue to rise in the future, what they're basically saying is that land is going to get cheaper and more plentiful. Labor is going to get cheaper and more plentiful. Materials are going to get cheaper and more plentiful. And the government's going to make regulatory costs of building a house cheaper and easier. And guys, when we just think about these four input costs, land, labor, materials, and regulatory costs, do we really think that any of these input costs to building a home are going to fall in the future? I doubt it. So if land, labor, materials, and regulatory costs are going to continue to go up, then home prices probably will continue to rise in the future as well. The average home is selling after being on the market for just 10 days. When we compare that to the inventory of unsold homes, we can see that those homes have been on the market for an average of 46 days. What these two data points tell us is that if a home is properly priced, it will sell in a very short period of time, right now in about 1.5 weeks. However, if a home is not properly priced for its location, condition, and amenities, it will stay on the market for an extended period of time, right now about 1.5 months. Next, let's take a look at year-to-date new listings versus the same period 1 year ago. So we're looking at the first 4 months of information, right, for 2022. So January, February, March, and April of 22 versus 2021. And here we can see we're down 8.05% for that same time period year over year. Now, when we look at this information in a numerical format and we can see the last 7 years of data, what we can see here is that so far for calendar year 2022 through the end of April, we have had 2,740 new listings come to market. That's down 240 listings or 8.05% versus where we were at the same period of time in 2021. You can see if we go down to the bottom of this chart, down to 2016, that in 2016, for the first 4 months of the year, we had 3,703 listings come to market. So compared to where we were in 2016, we're down 963 listings or 26%. Guys, 26% fewer listings so far for the first 4 months of 2022 versus where we were in 2016. And as you start on 2016 and work your way back up the chart, you can see that the numbers have been dropping, okay? So all of this is contributing, right? Fewer listings coming to market, while you've got millennials, right, which is a big, this is one of the biggest buying groups now. People, moving out of their parents' house, they're forming families, they're getting married, they're having children. So we've got a big demand for housing, and there's fewer and fewer listings coming to market as the years go on. And there's numerous reasons that this is happening. But, and this is not a short-term problem, guys. This is not going to correct itself anytime soon. Now, let's move over to year-to-date closed transactions. So where we were just looking at the listings, let's take a look at the closed transactions. And again, for the first 4 months of calendar year 2022 versus 2021, we can see that we're down 12.35% in the closed transaction category. And when we look at the numbers, we can see that there were 2,171 closed transactions for the first 4 months of 2022 versus 2,477 closed transactions for the first 4 months of 2021. This means we are down 306 closed transactions, or 12.35% versus where we were 1 year ago. And again, when we go down to 2016, you can see that for the first 4 months of 2016, we had closed 2,814 transactions here in Kent County. So compared to where we are this year, we're down 643 closed transactions, or 22.85% fewer closed transactions for the first 4 months of calendar year 2022 versus where we were in 2016. And again, if you look at these longer term trends, right, and I like to look at these trends as a businessman, as a sales professional, and you look at these trends and you can see what is happening. And as in 2017, right, for 2016, obviously we had 2814. When we move up to 2017, we had dropped almost 300 closed transactions right there for the first 4 months of the year, 2,504. And then as we work our way up, right, we can see that the numbers have kind of dropped down to 2,400 or below. And of course, this year at 2,171 closed transactions for the first 4 months of the year, by far the lowest number that we have seen over the last 7 years. Next, let's take a look at the average months of inventory in Kent County. Now, so far for the first 4 months of calendar year 2022, we're running 0.5 months of inventory. That's about 15 plus or minus days, of course, depending on whether it's a 30-day month or a 31-day month. But when you're running 0.5 months of inventory, guys, that is a super, super low inventory number. And again, all of this, right, is contributing to this rapid increase in prices that we're seeing. And again, there isn't any short-term solutions to this. This problem is not going to fix itself anytime soon, okay? So we're going to probably more than likely continue to see, I'm just going to give this away and then we'll go back through the average months of inventory, but I just want you to understand that and a lot of people are out there saying the housing market's going to crash. The housing market's going to crash. First off, and you can see this if you look at, data all over the place, and there's a lot of people with a lot of opinions. But when you look at the facts, when you look at 80 million millennials, right, the youngest of which are still teenagers, that are going to be buying houses. The average person, the first-time home buyer, is about 31 years old, right? So if you've got millennials that are still teenagers, and that's the largest demographic that has gone through the U.S. population since the baby boomers, which there was about 70 million boomers. I am a boomer. I'm on the tail end of that, one of the young boomers, but I'm still a baby boomer. And when you look at the millennial group, right, 80 million of them versus 70 million boomers, and the youngest millennial is still a teenager, guys. And, the millennials are going to get married. They're going to move out of their parents' house. They're going to have babies. They're going to want to own a house. And so you've got a huge demand, and we've underbuilt houses, guys. We've underbuilt homes for the last decade plus, in large part, there's numerous reasons for this, but in large part due to the housing debacle, if you will. And again, there was numerous reasons for this, but the 07 through 09 downturn in the stock market, and of course the housing correction back then. But there was numerous reasons why, right? We had a false market in housing. It corrected itself. It overcorrected, if you will. But the point is that, a lot of people are comparing where we're at now to the 2007 through 09 time period. And guys, it's not the same. It's not even close to being the same, right? We had, wild speculation. Anybody that could fog a mirror could get a loan. They could get 4 or 5 loans. You didn't even have to qualify. I mean, it was stupid what was happening back then, and we're not even close to being in that same position right now, all right? And if anything, it's the exact opposite, where it's been difficult for a lot of people to get their hands on capital, right, to get a mortgage, to qualify for a mortgage, which really is the way it should be, right? If you can't afford a mortgage, you can't afford a mortgage, right? You shouldn't, if you can't afford anything, it doesn't matter what it is, you shouldn't be able to buy it, right? If you can't make the payments, if you can't keep up with it. So that's just being responsible. But we have not seen builders over the last decade plus, right, home builders across the nation, which most home builders are smaller, right? They're local. There's very few nationwide home builders. So we have not seen the speculation in home building where, the home builders, like when I was a kid, there used to be huge whole residential areas being put up, hundreds of houses at one point. You just don't see that like you used to, decades ago. So we're not seeing these entire subdivisions being created that are creating new housing, especially at the lower end, say under $300,000, $250,000 homes here in the Grand Rapids area. You're not seeing that. Okay, and there's, again, numerous reasons for that, and I alluded to that earlier in the video. Land, labor, materials, and regulatory costs. Guys, there's a certain price point where a builder just can't build a house and be profitable. So, again, I hope you understand what I'm getting at here. These problems, are not going to fix themselves anytime soon. And just so you understand, if you're watching this video, I'm not, my background, I've got an extensive background in finance and economics, in business. And so I come at this perhaps a little differently than most realtors. I mean, no disrespect to anybody else that's in the real estate business, but my background is unique for what I'm doing here, in that I do have an extensive background in financial services, in economics, in finance training, that I'm also bringing to the table here as a realtor. Okay, so I'm able to think through some of the economics behind this and the reasons for this, perhaps at a different way than somebody that perhaps doesn't have my business, finance, and economics background. Okay, so. Guys, the housing market's going to crash. The housing, people saying that's first off, that's just stupid, and I think it's irresponsible. First off, what does that mean, right? When you say the word crash, I don't care if you're talking about the stock market, the real estate market, that is not a quantifiable, again, that means, so I want you to understand, I'm not going to say that. I will never say that. I don't, the inputs necessary for a major correction in housing, in my opinion, are not there, right? We've got super low unemployment. I mean, we've got a problem with trying to find enough workers, not high unemployment where people can't make their mortgage payments. We've got low unemployment, right? High employment. So, and we have underbuilt, not overbuilt homes. We've got a huge demographic, millennials, first-time home buyers, average age 31, right? You can look that data up. That's the statistic. It's been like that for decades, right? That the average person buys their first home about age 31, and that is a huge percentage of the home buyers are first-time home buyers. So, guys, we just do not have the situation based on all the data that I've seen. And again, with my background, we just don't have the recipe necessary based on what I'm seeing for housing prices to fall across the board, especially on the lower end. Now, there might be areas in, the 20, 30, $50 million properties on the coastal areas where the speculators have overbuilt, and you might hear about those things coming down, right? An $80 million penthouse, in Manhattan, that's selling for $50 million or whatever. But that has nothing to do with, the average house in the average area in Midwest, the Midwest of the United States. Okay, the $300,000 plus or minus price point. Those overbuilding, the overbuilding of the multi-million dollar properties on the coastal areas, that has nothing to do with what we're dealing with. The other thing I want to touch on real quick here, guys, and perhaps I'll do a whole separate video of this. Yes, interest rates have gone up a little bit here over the last few months because they were extraordinarily low, in part to to what the Fed had done, the Federal Reserve had done to drop interest rates to stimulate and to stimulate the economy and get things going. And now they're going in the other direction, pulling back on that stimulus and trying to reduce their balance sheet. I know I'm going much deeper from an economic standpoint in this video than I normally do, but I just want to get some of this stuff out there so you guys understand, number one, me, right, a little bit, and understand that I'm somebody that can help you. But I also want you to understand the facts. Interest rates from where we're at right now on a 30-year mortgage are still historically extremely low, all right? Even if you get a mortgage somewhere in the 5%, 5.5%, whatever, from a historical perspective, guys, that is still an extremely low 30-year mortgage. All right. And look, if interest rates do fall in the future, you can just refinance, right? If somehow they magically go back down to, the low threes or mid threes or whatever on a 30-year mortgage, which I don't think that's very likely anytime soon, perhaps not even in our lifetime again, okay? And it's just, again, perhaps I'll do another video on it. If you have any questions on this, what I'm talking about, give me a call. The phone number, of course, is on the video here, and I'd be glad to talk with you about this. But, and look, I'm not Nostradamus. I can't predict the future, but just looking at the reality of the situation, economics, understanding interest rates, historical, not just from a real estate perspective, but again, with my extensive multi-decade finance background, including being a vice president for a major mutual fund company in the past, being a financial advisor, and obviously now and I've been in real estate for many years now, as well as I've owned rental properties and things in the past personally. So I've got a background in this stuff, guys, and we don't have the situation here where, number one, interest rates are probably going to fall anytime soon. We don't have a situation where we have low demand because of decreasing population of people trying to buy a home. We've got an increasing population of people trying to buy houses. We've got, still from a historical perspective, extremely low interest rates, extremely low 30-year mortgage rates. It's probably easier now to get a mortgage than what it was even a few years ago, right? After the downturn, because banks were very hesitant to lend. So we probably have a more normal situation here, except that we have underbuilt homes, especially, on the lower end, if you will, the sub 300 range from where we're at right now. And we've got a lot of people that want to own properties, and we've got a very low amount of inventory, and a lot of people aren't moving because they're not moving. All right, I've got people that tell me, well, gosh, I'd love to move and get a different home or whatever around the Grand Rapids area, maybe sell my property in downtown Grand Rapids, move out to Lowell or something like that, but I'm afraid if I put my house up for sale, it's going to sell so fast, and then I won't be able to find another place to live. So I hope you understand what I'm saying here, guys. Some of this stuff is feeding on itself, and I think over time that will help, that will smooth out. We've just got a situation here that, and if you want to buy or sell a property, I want to help you. I'm trying to encourage you just, let's go ahead and do it, right? Because this situation we have is not going to correct itself anytime soon. And if you're waiting for housing prices to fall, I think you're not looking at this in the right way. And it's extremely unlikely, guys. Land, labor, materials, regulatory costs, those things are probably not going to go down, any one of those four inputs, let alone all four of them. We're probably not going to have a lower demand for homes for decades. We're probably, we haven't seen an overbuilding of properties, so there's just not this situation necessary, and we're not seeing major employers here, one of the top 100 employers or whatever, top 50 employers in the Grand Rapids area moving out of here and firing and laying off a bunch of people that are going to have, that are not going to have any income, that are going to be selling their houses, putting it up for sale, driving the properties lower. We're not seeing this type of stuff, okay? So I know I went much deeper and got a little bit geekier than I normally do, but I just want you guys to understand, right? I've obviously been thinking about this stuff, and I wanted to share it with you because I think it's extremely important that you understand the facts and remove the emotion that a lot of people have, and just these opinions that are coming out of nowhere with no factual basis of, housing prices are going to fall, the market's going to crash. That's just, guys, could it happen? Of course it could happen. But is the writing on the wall right now? No. And just because something, again, I don't care if it's a stock market or real estate, just because something has gone up in value, especially with real estate, right, because it's got some unique attributes, just because housing prices have gone up doesn't mean that they're going to go back down to where they were. A lot of people are, I think, trying to, get prices from 2015 or whatever. And that's, I don't think that's likely, guys. Just again, we've underbuilt homes tremendous demand, land, labor, materials, regulatory costs. I mean, people are worried about inflation. Well, if inflation is going up, guess what it's going to do to your house? The housing prices have to go up. So how can people simultaneously be worried about inflation and think housing prices are going to go down? Those two do not gel. Okay. So if inflation is going to be a reality for quite a while, and it probably is, on anything that's physical, food and things like, anything physical, right, that can't be digitized is probably going to continue to go up in price. That also means housing. So, how can we have rising inflation and rising house prices and a housing crash? Again, what does this mean? I get crazy when people use that word crash because it's so irresponsible, whether it's with respect to the stock market or housing, because it's a non-quantifiable number, okay? So anyway, I hope I've given you some perspective, some things to think about. Please give me a call. Whether you're looking to buy a house, in 2 weeks or, the next year or two, whatever, I want to help you, okay? But let's start to form a relationship, and let me help you, whether you want to buy or sell a property here in the in Grand Rapids or anywhere. If you're watching this outside of the Grand Rapids area, I have a network of realtors that I can work with across the United States, where I can help you. Okay, so. Just to kind of wrap this up here, average months of inventory, again, 0.5 months of inventory, guys. If you look down and now in this category, I have more information available to me. I can go back to 2013, so you can clearly see that at 0.5 months of inventory, that is by far the lowest inventory number that we have seen in many, many years, right? If not forever. And if the highest number that we've seen even over the last decade basically is 2.3 months of inventory, which, guys, I can tell you that is a super low inventory number at 2.3 months of inventory. So why does inventory matter? Well, as we can see here, if you have between 1 and 2 months of inventory, you probably are going to experience double-digit price appreciation on homes. And that is exactly what we have seen for many years here in the Grand Rapids area. If you're running between 3 and 4 months of inventory, you would generally experience single-digit price appreciation. If the inventory built to where you had between 5 and 6 months of inventory, this is more of a normal, balanced, or neutral market where you might experience some price appreciation, but it would more than likely be in the low single digits. And if you're under 5 to 6 months of inventory, this is considered a seller's market, and that's exactly what we have seen for many years here in Grand Rapids. If you're over 6 months of inventory, this is considered a buyer's market. And if your inventory built to between 7 and 8 months, that's when you would most likely experience single-digit price depreciation. And then if the inventory built to 9 months plus, that's when you would likely see double-digit price depreciation. So 7 to 8 months of inventory, single-digit price depreciation, 9 months plus, that's when we start to get into double-digit price depreciation. Are you looking for a realtor you can trust? Would you like to work with a realtor who is knowledgeable, professional, polite, honest, integrable, communicative, and hardworking? If so, look no further. Whether you are looking to sell or buy a home in the Grand Rapids area now or at some point in the future, I will help you make that happen. When you are ready, let me put my decades of sales and business experience to work for you. When you think real estate, think Rodney. I will work quickly to help you achieve your real estate objectives. Call me directly at 616-258-4782 to discuss your situation or to just talk about real estate. Also, don't forget to add my name and contact information under the title of Realtor or Real Estate Agent into your cell phone. This way, the information is instantly available whenever you need it. Thank you for telling your friends, family, and colleagues about me. I appreciate you spreading the word, and I look forward to helping you succeed.